Good afternoon, everybody. Welcome to my channel, Data-Driven Decisions. Today, we're going to talk again about Dave Ramsey. Um, I've made 2 videos on it so far. In the last video, I was speaking positive about Dave. I found his ETF, portfolio, the baby step portfolio. I found it in ETFs, and saw that it did fare quite well as far as its return of 9.3. I didn't know the standard deviation or the risk, but I just kind of took a look at it on the scatter plot I have, and saw that 9.3 is really good. It's a pretty good basket of funds. But the more I think about it, I've been reading you know the the Four Pillars of Investing by William Bernstein, second edition, and it's just really getting me back into what I already know, but it just feels so good to read it again. And I stand here to say, you know what, I am not on the Dave Ramsey bandwagon. I've been following Dave for a long time. I'm inspired by him. I go to church, and that's where I found out about him. And he definitely was of great help to me in getting out of debt in my early years. Just fresh out of college, I had a lot of student debt, and I had a car loan, and thanks to him, I just fully focused on my debt and got rid of it pretty quickly in about 2.5, 3 years. It was quite phenomenal. I remember I was almost possessed just to do it. And it was definitely the best decision I made in my young future to really get me to where I am today. Nothing special, but I'm in a good financial position. I have some wiggle room. I have some cash, and it feels good just to have that security. But with Dave Ramsey and his investing advice, I just what he says is not sound. Uh, he always makes it sound so easy to just pick outperformers year over year. It's not that hard. You just got to look at the perspective, and you just see how it consistently beats the S&P 500, and yeah, that's the one you pick. That's kind of how he sells it. And he also says, there's no, you know, you can't do it on your own. You need helpers. There's nothing wrong with paying somebody for help, to do it for you. So basically, he's leading his followers to active management, and that's another big no. So reading the real books on investing, William Bernstein, Jack Bogle, Charlie Ellis, Burton Malkiel, there's tons. They all say the same thing, and it's not what Dave says. Dave definitely leads you to the wolves with investing. You can't consistently beat the market. And if you think you got a fund that's has outperformed the market, odds are it's going to underperform the market in the future, thanks to reversion of the mean, which is a common fallacy for all outperforming funds. They fall back to gravity, and end up usually doing worse um, than the market, especially if it's a fund that gets really popular, because then it's got cash drag. It means every time it buys and sells, it's got a lot to buy and sell, and that always drives the price in the negative direction of what they want it. Just because if you got a lot of shares to sell at a certain price, in order to sell those shares, you're going to have to the buyers are going to rack up the price, so you're going to end up buying those shares at a higher price, and that's called cash drag. Needless to say, you can't find consistent winners in the market. That's hocus pocus garbage. And I stand here today, and after reading, just reading William Bernstein, I am not changing my mind. I know my plan. I know it works. I'm just betting the entire stock market, and not letting any other variable come into play. And I'm just sitting still, doing nothing, not moving my money, not reacting to the news, not seeking advice from anybody. Um, let's just be honest, nobody reads, and I read, and that gives me an immense leg up on everybody else, because everybody else just sways like dust in the wind to the latest news, so they don't know what they're talking, because they don't, they don't have the ground of books that really tell them, what's constant, what's steady in the market, what to do, what not to do. If you really want to learn investing, there's plenty of investment books out there. Read the ones from the Bogle camp. It all started with Jack Bogle. He founded the first index fund. He created Vanguard. He gave private investors like myself a safe place to invest without having helpers eaten away at their retirement. The truth is, if you get active in management, you're going to end up with a third of what you would have received if you didn't receive those helpers. That's how big their expenses are. It doesn't seem like a lot year in, year out. It's only maybe 3-4%, but that's the difference between getting a return of, say, 10% and 6%. And that's a huge difference over the span of 20 years. And that's why compounded, at the end, without seeking helpers, without having active management, without having having a heavy expense ratio, it's going to really eat away at your retirement, and you're going to end up with probably a third of what you would have had. So, even with the ETF portfolio that I saw from Dave Ramsey, it isn't exactly the portfolio. Uh, you know, Dave Ramsey likes growth companies. He likes large cap. He likes small cap. Or the what's the segment where the newcomers, the new hot newcomers, and he's really into the hot stocks, and those typically don't do as good as the value stocks. Warren Buffett, he's really big on being a value investor. Unfortunately for 20 years, value investing hasn't really panned out. It hasn't really done much better than the S&P 500. I think too many people know about that advantage and now it's baked into the market, but I'm still placing my bets in small cap value, because that's always the segment that does the best, and that's usually the segment that nobody really likes to invest in. Those are the boring small stocks that um, you know technically they have to provide better returns in order for them to even be bought, and that's kind of why you want to invest in them. But nobody really likes to invest in the small cap value, but uh, in history, that's always the segment that's outperformed all other segments. So there's another thing where Dave goes wrong. He really kind of wants you to go with the hot growth stocks, and the ETF portfolio that I put together was not exactly what Dave proposed. They were more broad, just a mid cap ETF, just a small cap ETF, not really segmented by growth or value. So that kind of makes the portfolio better, in my opinion, because it's not so swayed towards growth. But nonetheless, that isn't what Dave Ramsey's portfolio actually is. What he says, he first of all, he tells you to invest in active management, and you know you need to know that if you have active management, you really don't get to choose what you invest in. They're going to do the investing for you, and there's going to be a lot of turnover, so high transaction costs. You're going to get hit with a big expense ratio. You're not going to outperform the market. The truth is, random monkeys throwing darts at a newspaper of stocks will do better than or will do just as good as active management. Active management, they're all competing against each other, and theoretically they have to get the market average and then minus their expenses, which is pretty hefty, 3-4%. So if you go with active management, you're going to get the market average minus the expenses, and that's always going to be far below what you would have received if you just invested in the total stock market. So um, you know Dave Ramsey, he's great. I love the church. I love going to church. I love the Dave Ramsey, philosophy of getting out of debt, giving yourself um, a nice savings for you just, before you invest, and that's all great. But once he takes you to the investment side, he kind of leads you to the wolves. He tells you to go for active management. He's not truthful in him saying, he says how easy it is for just to pick um, outperforming stocks year in and year out, when in actuality that is impossible to find. That's never um, really happened. I mean, if it does happen, it's by sheer luck. The funds that do bad, they just kind of throw to the dustbin. So there's that survivorship bias. A lot of big funds, they have these incubator funds that they don't know how they're going to perform, but just by random luck, 1 in 10 is going to outperform the market. They scratch all the other funds that didn't do better than the market, and they just market the crap out of this incubator fund when it got to where it is just by sheer luck. And don't think for a second that it's going to keep following suit and give high returns. What it's going to do is revert to the mean. It's going to, because it had high performance, and it was by sheer luck. Um, you know, it's usually going to underperform the market just because it once overperformed the market. That's usually how it goes. In actuality, it should just get the market average. But most of the time, when you pick a hot mutual fund that has had great performance in the past, expect very terrible performance for the next 10 years. That's usually what happens. It's called reversion to the mean. So I come to this video just to say, don't follow Dave Ramsey's investment advice. It's not good. And I had to read an investment book. I haven't read one in a long time, just to kind of get my senses back, to not be in favor of Dave Ramsey. I've known this for a long time, that um, he's not good advice to follow. I've listened to him. I've tried to find his investment advice. I find it rather vague, and I find it he's a marketer. He's trying to lead people towards active management, and what he says is not truthful. You can't find stocks that consistently outperform the market, and if you do, you're in for a bad future, because it's going to revert to the mean and underperform the market. That's what always happens. Even Warren Buffett, he hasn't been outperforming the market for the past 20 years. So even he is reverting to the mean. If Warren Buffett, the greatest investor of all time, can't beat the market, what makes you think you can? You can't. There you're playing against an invisible competitor on the other side of your trade. You're playing tennis against a random competitor, and guess who it is? It's Serena Williams. You're going up against, you know, big algorithms that are capitalizing on every bad move you make, whether you sell too low or buy too high. There's algorithms that really know everything about the market. It's known as the efficient market hypothesis. Everything about the price of a stock is already baked into its price. So whatever you think whatever you heard on the news, it's already baked into that price. It's too late. You're not gonna catch a wave. If you follow the news, if you follow financial advice, you are gonna underperform the market by a great amount, because there's a lot of people trying to take advantage of that news, and no matter what, you're always going to be late to the party. It's already too late for you to make an advance on that stock. It's probably already, you're going to be buying it too high, and by the time you get it, it's just going to slowly coast down. That's how it usually happens. That's how it was in my young career as an investor. I, believed in active management. I believed in beating the stock market. I believed in active trading and day trading. I really wanted to know how to do that, but I don't do any of that anymore. I haven't really moved any money in my portfolio for over 2 years. I have no need to change it. I barely even look at it. I'm very confident in the way I put together my portfolios, just broad total stock market index funds. You know, I play some segments a little bit. I'm very biased towards small cap value, so I play a lot in that field. But the best thing I've ever done was just start reading books on investing, because without that base knowledge, you're going to be swayed by the news and by people and by critics. But with my knowledge, there's no I'm an immovable force. There's really nothing anybody can say to me that will make me jump and get me excited and believe them. I know they're all full of crap. Anybody who thinks they know something about the market is full of shit. A monkey can do just as good as an active broker, and that's the truth, and that's been proven many times. So don't follow Dave Ramsey's investing advice. It's crap. He's leading you to the wolves. He's leading you towards active management. You can't outperform the market. He says he outperforms the market year in, year out, gets 12, 14% returns every year. He's full of shit. That can't happen. He's full of shit. And there's a reason why he won't share his investments with the world. He's he's all fluff. Whatever he says is not true. He's not consistently outperforming the market. He's not consistently getting 12, 14% return on his money every year. It's not true. And I come on this video to really set that straight. My last video, I was leaning towards Dave, saying, this is a pretty good ETF fund. It does pretty well, but truth is there's better ones out there, and even with that 9.3 return, I guarantee the ones that are doing just as good as that have a lower standard deviation. So I'm going with those ones. Just knowing what that portfolio is, what Dave believes in. He believes in the hot growth stocks. That's a volatile ride. No, it's not good. It's not good advice. Don't follow it. Don't follow Dave Ramsey after baby step 3. Until then, yes, he does a good deed, telling people to get out of debt, telling people to build a savings. But once you build that savings, you need to go the Jack Bogle route and jump off of the Dave Ramsey bandwagon. You need to get into Vanguard. You need to get into index funds. You need to invest in the total stock market, and let out all the other people unaware of investing, go with the active management, and you'll be in 20, 30 years. I know I'm going to do great in my retirement. The only big factor is just how much money I put in each month. That's the determining factor. But the asset allocation, what I'm investing in, I have no question what I'm going to do. I'm just going to invest in the total stock at market index for the rest of my life is what I'm going to do. When Warren Buffett dies, all his investments are just going into broad index funds for his family. He's not going to let his family ruin all his fortune. He's going to do right by it and just put it into the stock market, and it will grow and grow and grow, and his family will be rich for centuries. So I hope you like this video. I hope this really puts some sense into you. Don't follow Dave Ramsey's investing advice. He believes in active management. He believes in outperforming the market. If you read books about investing, all that is crap. It's all marketing fluff, and it's the worst advice you can get, because it's just going to make you jump into active management. It's going to make you become a day trader yourself. It's just going to make you do terrible things with your money, when all you need to do is just throw it in the total stock market and just keep putting money in there, and don't think about it. Don't move the money. Just keep growing it in the total stock market, and that will always do better than 80% of people each year. And in 20 years, it's going to end up doing better than 99% of people. I'm not making this up. That's the truth. So average returns is always going to produce better than everyone else, because everybody is underperforming the market most of the time, because most people are in active trading, and they're in aggregate are getting the market average minus expenses. So that leaves them 3-4% on the negative side in comparison to the market average. If you just go with the market average, it's rock bottom expenses. Your expense ratio is going to be like 0.1%, barely anything, in comparison to like 3-4%, which is a lot. and you're just going to get your fair share of the market, and that's all you can ask for. I would have hoped that, Dave Ramsey, all his noble advice about getting out of debt, this would be his advice. Just invest in the total stock market index, throw all your money in there, and you'll be great. And I just wish Dave Ramsey gave that kind of advice. I really wish he read his books and followed Jack Bogle and led his followers down that path. But instead, he leads his followers down active management path. That's the wrong path. Don't go there. I know Dave Ramsey is involved with the church, and that's great. That's how I got involved with him. But there's no denying his investment advice is not good. It is wrong, and you don't want to follow it. So that's all I got for this video. Thanks for listening. Have a good one. Bye.